Okay, I think we'll make a start. If there are any late arrivals, we can always admit them as and when they join. So I will start by saying welcome. Good to have you all with us. My name is Simon Horsfield. I'm one of the partners in Horsfield Menzies, and it's my pleasure to be hosting this webinar today on the exciting topic of employment taxes. If I'd have had my time again, I would have called this Time to Talk Tax, but I didn't think of that at the time. So it is instead a conversation with David Chandler. So I'm going to introduce David in a moment, but you'll also see on the screen that I'm joined by my colleagues Chloe Leyland and Joanne Alvey. Angus Menzies is also dialing in as well. So at this point, I'm going to hand over to you, David, to introduce yourself and the topic that you're going to be talking on. At this stage, I will simply say it is everything you need to know about employment taxes in 30 minutes. So you can expand on that as you see fit.
Excellent. Thank you very much, Simon, and good afternoon, everybody. I guess by way of introduction, so David Chandler, chartered tax advisor, worked in tax for far too many years, and have known Simon, I think now for just over 6 years when we started working together. So thank you for that. And clearly you need to work on the marketing side of things, take longer to think about it.
Yes.
So I'm going to cover employment tax today. I think when Simon and I discussed this, the hardest part I think at the minute was thinking about what not to include. Employment tax has been a very, very topical subject, I think, for the last sort of 4 or 5 years. There's been lots of changes, and I'm just going to try and go through some of those today. Just go on. So I've got a brief introduction, and I'll explain why is employment tax important right now. 15 years ago, it was all about corporate tax, VAT. Now employment tax has got its own importance, I think. I'm going to cover a bit about updates. So I'm sure all of you will be aware of the budget, the non-budget and the re-budget and all the repeals, etc. So I just thought it might be useful to spend a few minutes actually going through what are the rules now. I'm going to cover IR35. IR35 is one of the things that they mentioned in the budget, but it doesn't go away. The rules are still important, and as a corporate entity, employers now have the obligations, but I'll come on and talk about those. Thought I would cover a bit about card salary sacrifice. It's not all compliance. There are some things companies are doing and looking at. So I'll cover a little bit about why is that such a topical issue in employment tax. Obviously, we're now in February, year's racing by already. So we're coming up to the end of year. So again, a few minutes on what the end of year processes look like. What do we need to make sure we're doing as corporate entities? And then if I've got time, a whistle stop tour of a couple of other bits and pieces, which are, as I say, topical as I'm seeing them in the current environment.
David, just bear with me 1 second. Apologies. Housekeeping. I should have said, number one, we are recording, and the recording will be made available to those who've joined afterwards. Please feel free to share that recording. Secondly, any questions as we go, use the chat facility. I'll be monitoring that, and I'll be able to put those questions to David at the appropriate time. So apologies. Back to you, David.
Excellent. Thank you very much, Simon. So before I start with in detail, I will do my best to remain totally impartial and stay off the political spectrum. But if I do veer into anything, I do apologise in advance. I can be a little bit cynical at times with some of the stuff the government have done. So why is it important at the minute? And so I just thought, for context, it was important to understand where employment tax sits. So as a country, as a government, we collect, or the HMRC collect, because they're the collectors of this, they collect around 730 billion in taxes. Well, it's somewhere between 700 and 800 depending on what period you look at, but in 2021-22 they collected 730 billion. It's a big number. Of that, over half, or just over half, comes from PAYE tax and NIC. Obviously, you have all of the others: VAT, direct taxes, inheritance tax, fuel, stamp duty, blah, etc., etc. But by far and away, PAYE is that biggest number. So it's an important thing. On top of that, we have what the government refer to as a tax gap. And the tax gap is essentially the difference between what they collect and what is owed. And that estimated to be between 30 to 35 billion most years, but currently it's about 32 billion pounds. So whenever the statements come out from during the budgets, and the government announce things like we're going to invest in this because we need to look at these areas. So there's a lot of areas which get focused on and provided with enhanced funding in order to look at the compliance aspects behind it. And employment tax is exactly one of those. So what we're seeing within the employment tax space is there's a number of items, and one of the most basic ones at the minute is what we call nudge letters or one-to-many, and we're seeing more and more companies be sent these. And nudge letters are simply a letter to a company, an individual, a group, partnership, etc., where they may feel there's an area of concern. And so it's then passing that responsibility on to the recipient of the nudge letter to say, look at your affairs and tell me if there's anything wrong. So there might not be. There could be things missing from a payroll report, from an RTI field, from an end of year, something to do with, say, consultants looking at IR35, but they will send that letter out to companies and then expect them to do something with it. It might be okay, but it might be a concern. So that's what we're starting to see over the last sort of 18 months. We've seen a lot of these nudge letters be going out. And that's not just employment tax, that's other areas of tax as well. So clearly it's a successful route to markets from an HMRC perspective. Obviously, we've got the senior accounting officer rules for large corporates, know your customer visits for sort of mid-tier and SME brigade. And when revenue come in and look at these, they're looking at things like, does a company have the robust policies in place from where employment tax is concerned? And the SEO side of things for large corporates actually passes the responsibility onto the individual, and they can be personally liable for where there are serious failures. So it does have consequences. In terms of the HMRC reviews, what does that mean? And again, for context, these can actually be quite intrusive to a business. So if they find something and they want to then come in and investigate it further, for large corporates, these can take, I've seen, up to 3 years. These take, so they are very, very disruptive to a business as usual type, because they'll come in, they can look in different departments, they can want to engage and interview different people within the business, can interview external people, especially if you use, say, contractors, and they'll review multiple sources of information. And if they find one thing, it's like unraveling a piece of string. They'll then look further and further into that. It's probably worth stating around where they can go back. So from a tax perspective, if it's just an error, they can only go back 4 years. And that's what everyone thinks. Oh, you can only go back 4 years. However, the things to bear in mind is if it's careless, and again, I won't get into now the Sahari thing about whether he was careless or he just forgot. But if it's careless from a tax perspective, you can go back 6 years. If it's deliberate or if it's fraud, and that is an interesting one, you can go back 20 years. Now, you don't tend to see many of those because obviously that's fraudulent side of things, and HMRC have to go to the courts to try and approach that. But if it's deliberate, they can open investigations as far back as 20 years ago. From a national insurance perspective, we're limited by the Limitation Act, so that is 6 years. And obviously, they will look at that and see if there's any tax and national insurance owed, and then seek to charge that on the employer, and then apply any penalties and interest. And this is the interesting bit that I think it was Jim Harrow, head of HMRC, said during the issue that happened a couple of weeks ago, was there are no penalties for innocent errors. So if you take reasonable care, you'll just be liable for the interest. But if it's careless, deliberate, there will be penalties. And those penalties can increase to 100% of the tax owed. In terms of some of the nudge letters, one of the ones we're actually seeing as well, it's probably worth mentioning, is around the CGIRS. Obviously, we hope COVID is behind us, but a lot of support was given to businesses throughout the COVID period, and all around the COVID job retention scheme, etc. There was a lot of complexity around how the rules worked, what people could claim, what they couldn't claim, etc. HMRC are reviewing 30,000 cases. They've only completed 8,000 so far. So although CGIS is now no more, there's still lots of ongoing compliance and ongoing reviews that we're seeing in the marketplace. Interesting as well, especially around CGIRS, is that there were a lot of reports from whistleblowers that HMRC are investigating. And around the rules were complicated, but one of the areas that we found to be particularly problematic was around the variable pay employees, because there was a complicated calculation for how you calculated what you should be claiming. And if you've claimed the wrong amount, then it's something you want to go to HMRC and not fess up, but be honest about if you've done something incorrect. Some of the other areas, NMW, national minimum wage, that I'd say in the last 4 years has become bigger and bigger in terms of an area of focus for HMRC. And I think part of the issue there, or the complexity there, is because the rules are set by the Department for Business, Energy and Industrial Strategy. Get the acronym right there, so BEIS, BES. But the enforcement is dealt with by HMRC. So you're dealing with two different areas. So BES write the policy and essentially the legislation, and then HMRC then write the guidance and compliance and then follow it up. So it can be quite complicated to get it right. One way that someone once told me about, that I always remember, there's 4 types of workers, there's 4 strict conditions. And generally, when you look at the detail behind it, that a lot of people are salaried workers, and that's all fine. The 4 strict conditions, if you don't meet those conditions, you fall back as then what's deemed as unmeasurable. And when you fall into the unmeasurable category, that's when it can be quite complicated, because you are at risk of getting things wrong. And that's just in terms of things that you might include or not include within the calculation for national minimum wage. And some of the examples I've seen is you might have people earning £50,000, which is a huge amount of money, actually falling foul of the national minimum wage calculation because of payments, deductions, reductions, salary sacrifice payments that they might do into their pension, etc. Once you take into account a lot of different things, it can be quite complicated. What's the problem with it? You get named and shamed as a corporate, in addition to the penalties that will apply for getting it wrong. Some of the other areas that we're seeing increased activity from HMRC is around the off-payroll worker stroke IR35. I'm going to come on and talk about that in a little bit more detail. Optional remuneration, that's been here since 2017 now, so it's fully embedded into our legislation and acceptance. HMRC are still seeing areas of failure within that. So things like the P11Ds, which I will come on and talk about, clients might not be looking at and taking the higher of the cash or the benefit for those. So again, it's an area of review and concern we're seeing. Interesting one actually from a timing perspective is client versus staff entertaining. Obviously for the last probably 2.5 years, no one's done any entertaining because we haven't been doing face-to-face. But as client entertaining is now starting to become a little bit more prevalent, we're doing face-to-face meetings. This is becoming a hot topic again, making sure that you're getting it right, the different treatments between whether something is staff entertaining or whether something is client entertaining. PSA, what does PSA stand for? That is a PAYE settlement agreement. Again, I'm going to come on and talk about that as part of the year-end processes. But again, it's a hot topic for HMRC because they want to make sure that companies are paying the right amount of tax on any benefits that are provided to their employees. Short-term business visitors, again, something which probably stopped quite a bit with the COVID time, is now starting up again. As you've got people moving around from an international perspective, that has implications. The general rule is you should pay tax where you work. So if you've got people working overseas, there could be obligations there. If you've got overseas people coming to the UK, they could have a tax obligation. Those obligations can be eased, but you have to make sure you've got a STBT or STBV application in place, what used to be called Appendix 4. Termination payments, again, there were massive changes 2018, 2019, etc. There's the now PENP calculation, which I have lots of conversation with Simon about, which has made the calculation very, very complicated, regardless of whether people work their notice or not. And then again, an interesting one is the cost of living crisis. So again, one of the things I'm seeing from clients is whether they can do things to help their employees. So whether that's through reward schemes, whether that's increased pay, sort of loans, vouchers, benefits, etc., all of them have a tax implication. So you do need to think about what the implication of setting up these types of schemes to help your employees have from a tax perspective. So very quickly on the budget, the key points. We had the mini budget. It was announced as a mini budget, then it was quite a major budget. Then we had the autumn. I've called it a budget there because it was big enough. It was an autumn statement, which was less dramatic, but it reversed some of the things. I'm going to come on and go through those. I've put HMRC there because it's a key point. What happened during COVID is a lot of the staff within HMRC moved to all of the support side from a COVID perspective. Obviously, with CJRS now ceasing, they're moving back into their business as usual. So they're going back into the normal review process, the normal, we need to be helping our clients, making sure they're paying the right amount of tax. So we're seeing much more business as usual, or how it was 3 years ago. And the last one there was an interesting one because I thought it was useful putting in there. So CIOT, I'm a member of the Chartered Institute. We now have Susan Ball, who was the president there. The last, I don't know, however many presidents have all been corporate tax or other tax areas. Susan is an employment tax person. And it's interesting that she has been raising these elements of taxes at a senior level and at government level. So it is getting a lot more traction. And I think the budget which we had in, or the mini budget and the autumn statement, was the first time that when the Chancellor stood up, they actually announced some of the elements of employment tax. And he announced things like to do with the electric cars rates stopping. Usually we have to look in the booklet and it's all hidden behind the scenes. Employment tax is getting a lot more traction at that senior level. So what happened with the mini budget? Again, I'm not going to talk through all of these. There were lots of changes announced at the time. This was obviously the Liz Trust, Kwarteng. They made lots of changes. When Jeremy Hunt then stepped up, obviously after one Chancellor left, he then repealed lots of these, stopped lots of them. Some of them stayed. Again, some of them are political, things like the banker's bonus cap, not going to get into that. Some of the NIC increases were reversed. But what are the rules now? So one of the things they said about the tax rate was going to drop to 19%. When in the autumn statement, they said now it's not going to drop in 2023. What they didn't say is whether it's going to drop in 2024 or not. So again, politicians' wording. They just said no specific data has been given. What they did announce was freezing the tax-free personal allowances and the NIC thresholds. What that means is more people, as they get these pay rises, as inflation goes up, generally people's salaries go up. We won't talk about the striking, but generally salaries are going up. So more people will be caught within the high rate of tax, obviously. And in addition to that, the additional rate threshold was lowered. It used to be 150,000, at which point people started paying tax at 45%. That has been decreased to 125,000 now. So again, more people are now paying a higher rate of tax as this salary increases. Scotland have an increasing number of tax rates. Again, their top rate of tax next, 23-24 tax year will be 47%. Obviously, the England and Wales is 45%. Lots of other things. The ones that are, again, I'll just pick out, fully electric cars. They announced that, so the rate has been 2% last couple of years. They've announced that that will be increased, but it's going to stay 2% until 25-26, at which point it will go to 3%, and then it will steadily go up to 5% in 2028. So they've put a lot of tax policy behind the encouragement into electric vehicles for company cars. And I'll come on and talk about that in a bit more detail. The other thing just to mention again on that slide is national minimum wages increased, so it's quite a lot higher. So again, where there's a national minimum wage check, you need to make sure where you've increased it that, again, people aren't breaching that if they have any salary sacrifice agreements or any deductions, etc. IR35, again, so to try and cover this in a few minutes, lots of rules changed over the number of years. The important one was that when the mini budget happened, they announced that the off-payroll worker rules, the IR35, was set to be abolished in April 23. Now, the rules that have come in over the period of time, and you can see the number of things that happened over the last sort of 10 years. What happened is, what they said is the company will have to take responsibility for assessing whether the contractor is an deemed employee or truly self-employed. So for years, it was the contractor's decision to decide whether they were self-employed or not, and then the corporate could then deal with them. The rules came about to say, no, the corporate was then going to have to deal with it. Mini budget came out and said, actually, we're going to scrap that. It's going to go back to the individual. And this was after the rules have been live since 2021. So a lot of corporates have put processes and procedures in place, I'm sure, as the people on this call will attest. So the fact that they abolished those rules was quite surprising. Obviously, then a month later, Jeremy Hunt came in and said, actually, we're going to continually repeal those reforms and continue to have those rules as we set them out originally. So what that means is it's business as usual. The corporate still has to make that decision. So it can be complicated because there's lots of detail and there's lots of different legislation which applies to workers. And the problem you have is because there's three categories. From a tax perspective, you're an employee or you're self-employed. But you have this concept of workers. And that's where it then gets difficult because you're covered by different legislation. Essentially, what we need to make sure is we have to look at things like what the agency rules are, what the managed service company rules are, what the off-payrolling worker rules are, and what the IR35 rules are. And they're different bits within the legislation. I guess that's why I work in this area. Excuse me. Essentially, the responsibility is back on the company. So the company have to understand where their workers are. And then what they have to then do is do the assessment to work out whether they're an employee, they're deemed employee, or they're truly self-employed. But it's understanding what the corporate structure is. Is it a limited company they're working through? Is it an agency they're working through? And so on and so forth. There is the CESS tool, which exists, HMRC CESS tool, which is good. And HMRC have said that they will stand by the result that comes from CESS as long as the information that goes into CESS is accurate based on the circumstances given. And a good example of that is, I put this on the slide because it was interesting, is that 5 government departments last year had to pay £263 million because they got it wrong. And they got it wrong because they relied on CESS. But their problem was that the individuals using CESS didn't know enough to answer the questions accurately. So the fact that they had done CESS, they'd got the status determination statements and they'd said these people were all self-employed. Actually, when HMRC investigated it, said you didn't answer these questions right because they based their answers on the contract, not actually what was happening in practice. So it's important to look at the contract. Yes, absolutely. And Simon will attest to that. Contract's important, but it's also important from a tax perspective to answer those questions based on what happens in practice. So if you have a concept, say a clause of substitution, but it never applies or it can't apply, then actually that might, mean your answer to that question would be different. The important bit to notice, so what steps do you have to do now? And again, just very, very high level. Do the rules apply? So you might be a small company, so actually there's a small company exemption, so you don't have to apply the new rules. Obtain the details of the profile of the contract. So is it actually a corporate you're engaging with, or is it a limited company? Obviously, you've got to do the status check. Corporate has to do the status check. It's the end user of the services who have to do that check and then issue the status determination statement. Then you've got to do that tax and NIC if necessary, and there is a process for appeals, which is 45 days. But what the revenue have said is that the clients need to take reasonable care. And the failure to take reasonable care then leads to the increased liabilities and pensions, etc. And care could just mean things like training, making sure the people doing the SDS have had training and understand they can answer these questions fully and accurately.
David, sorry to interrupt.
Yes.
One question I've had a few times recently, given that these rules have been in for some time now, is how often should that SDS be repeated? Because a lot of contractors are actually taken on a fairly long-term basis. Query whether that's right or not. But do you have a view on the frequency with which you should redo an SDS determination?
Yep, it's a very good question, and there's nothing in the guidance that says how often you should do it. What I would say is if you renew a contract, or if the contract is for a fixed period, then you have to do it at that time, because you're supposed to the status determination statement is based on the contract, not the individual or the entity. Okay, so if you renew a contract, or if you have a new contract at that time, if it's an open-ended contract, it's some of it depends on what that worker's doing. But I would say probably annually you should at least be doing a check. Not necessarily you have to redo the full SDS, but at least annually assess, has anything changed? Are the circumstances still the same as they were at the outset?
Thank you.
Next slide, I don't propose to go into any detail, but these are just three of the main areas that get looked at when you're looking at the status determination, and these are often the three that when the case law is announced, that are used as the reason for whether it goes to employee, deemed employee, or whether it goes to self-employment. So control is important. Who decides where, how you do the work, when you do the work, what the work is, etc. So if that's the individual, towards self-employment. If it's the company, it's more to do with the employee. Right of substitution. If you have a right of substitution, it is a very good thing from a self-employed perspective. And then mutuality of obligation. And the mutuality of obligation, I could probably spend days talking about, because and again, Simon probably would as well, because it's a legal aspect as to whether, is there an expectation I'll get work, and is there an expectation from the company that I will accept the work? But what's slightly interesting is that CEST doesn't really deal with the moot point, but courts do, which is why from a technical point of view, us tax advisors do say CEST is good, but it's not the overall solution. You do have to look at the overall engagement as a whole. On the next slide, I've just got some example cases. Again, I'm not going to go through them, feel free to look, but what's interesting, and some of these get a lot of exposure because of the individuals involved. They're on Sky, they're on TV, etc. Some people win, some people lose, but as the case of Lorraine Kelly won, because they were buying her brand, not the individual. But a lot of it comes down to who has the control and over what they do, and are they just working for that entity or other entities. But feel free to have a look at those if your heart's content. So it's not all about compliance. One of the topical issues at the moment, and we're seeing this very, very topical at the moment, is car salary sacrifice. Most people are aware of the ban on petrol and diesel cars, which is coming in from 2030, and PHEVs from 2035, which 2030 is not actually that far away, especially from a planning perspective. So the government, as I said in the budget, have encouraged the EV market, but their encouragement has been through a low company car tax rates. There is no real benefit through getting an EV on a personal lease, unless you can get a very good deal, which some people are good at, some people aren't. But there is not lack of supply, but a challenge for supply currently. So the prices of these vehicles is still fairly high. So the main financial advantage is through getting these cars through, or as a company car. What the government announced several years ago around optional remuneration was, if you provided a car and it was less than 70 or 75 grams or less, then OPRA didn't apply. So you can sacrifice your salary and you can get a company car, and you will only pay tax on that company car. You don't have to pay tax on the hire of the cash foregone and the benefits of the car. So if you chose a car that was 100 grams per kilometre, then you would have to pay cash on the higher amount of you would have to pay tax on the higher amount. So for normal ICE cars, internal combustion engine cars, salary sacrifice doesn't work. It only works for cars under 75 grams, so 75 grams or under. There are a few things you can salary sacrifice. It says on slide, you've got pension savings, cycle to work, childcare vouchers, and cars emitting 75 grams or less. Salary sacrifice is a concept that's been around a while. It's set effectively, the employee agrees to give up part of their salary, and in return for that, you provide them with a company car. Why you do that? the calculation for a car is simply list price times the scale charge percentage times the tax rate. The table on the screen shows the tax rate for an electric car and for plug-in hybrid vehicles. As you can see, the top line for electric cars is currently 2%. So 2% of an electric car, even though an electric car might be £40,000, it is a very tax advantageous benefit. So you could give up salary at 40% tax, 2% national insurance, and pay tax on 2% of the list price. So from a financial point of view, it's very advantageous. The next slide simply shows how advantageous it is. So all we've got there is I just walk through, say, the Mini Cooper, list price 28,000. If you tried to take that car under personal lease, it would cost you £545 a month over a 36-month period, just leasing it. And that includes things like insurance and everything else. If you sacrificed an amount for that car, you would have to sacrifice £511. And it's slightly different because of the way the costs work, because it doesn't cost the company the same as it costs an employee. But trust me in the numbers. If you sacrifice £511, from an individual's perspective, there's a tax and NIC saving, and they do have to pay company car tax. So that's £196 in total. So the net cost to that employee is £315. Okay. That means they would have saved £231 compared to taking that car under a personal lease. Now, obviously, they might not take that car. They might take another car. They could take a different car, etc. But you can see that there's a massive, massive financial advantage behind taking that car under salary sacrifice to the employee. In addition, if the employee sacrifices that £511, the company also makes class 1 savings. And in this case, in the Mini, you would save £70 per month. So the savings can be substantial. Obviously, it's 13.8% of the amount sacrificed. So this is why we're seeing a big increase in clients looking at this, and that's not just big corporate, it's mid-sized corporates and SMEs. Everyone's looking at, can they implement this? Obviously, you then have the practical questions around whether you can have an EV because of the range, because of the charging, because do you live in a flat, etc. But purely from a financial point of view, makes perfect sense. With any implementation, there are some, not devil in the detail, but there are some hoops and hurdles you have to go through and some decisions as a corporate you need to make sure you do. HMRC have said they no longer provide clearance for these schemes, so it's on your responsibility as the corporate to make sure you get these schemes right and they remain compliant. So you need to decide your policy decisions. Are you going to share the NIC savings? Are you going to include chargers? Are you going to offer PHEVs and EVs? Are you going to offer all types of cars, etc.? Which provider are you going to use for these vehicles? You'd need to draft scheme rules because the employee needs to sign up to these scheme rules to understand what they're signing up to. They'll need to sign up to an amendment to their terms and conditions, sort of employment law hat on. Someone will need to make sure the wording on that is tight for what is the employee signing up to. The employee will need to be able to model, be able to choose and quote their cars, etc. So how would you do that? Would the provider do it? Would you do it? And then obviously there's a payrolling obligation because this is a salary sacrifice. Once the employee signs up to it, payroll then needs to ensure that the right reductions are then made from their salary. And then the ongoing advice. So there is a little bit of complexity, and that's obviously why people like myself, Simon, and car providers are making sure we have some semblance of supply and advice around how we do that and how we can help corporates. Moving on swiftly, because I'm conscious of time, I just wanted to cover the year end. So year end process, because of where we are in the tax year. In terms of the year end, I tend to find it is quite simple. You've got things like the P60, you've got P11D, and you've got PSA. And each of these in turn, maybe just take a minute or two. So the payroll, obviously final reports need to be made by the 19th of April. Your payroll will do that. The P60s then, which is need to be sent to employees by the 31st of May. And that does include deemed employees. So anyone that you might have been a deemed employee because of IR35, you need to provide them with a P60 as well. Given you send pay slips out 12 months of the year, if you're running a monthly payroll, the P60 should just be a summary of those 12 pay slips. nice and simple, and then brilliant. I guess the challenge and the checks purely come when you might have had any reconciliation issues throughout the year. But hopefully that's a straightforward process, all done through payroll. The P11D form that's been around for donkey's years needs to be provided to employee and employer. You need to include all taxable benefits that have been provided. Standard ones, car schemes, medical benefits, loans, the main ones I see. And anything else that you've provided as a benefit to the employee. You can obviously payroll these expenses, and if you've payrolled all of the expense and benefits, you don't need to do P11Ds, you just need to do the P11DB, and then obviously pay over any Class 1A that you might not have, depending on how you've payrolled it. One small aspect, you don't have to provide P11Ds to leavers. Some companies do. You don't have to unless the employees ask for them. Once they ask for them, you then have to provide them by law. And obviously then you have to submit them to HMRC by the 6th of July, and then pay the Class 1A over by the 19th or 22nd, depending on how you provide it. Small point this year is because of the social levy and the national insurance decrease, the rate of NIC for this year will be 14.53%, which is purely part of the year at 15.05 and then part of the year at 13.8. Obviously, any business expenses don't need reporting, but staff expenses do, and I'll come on to that in a moment. Some of the practical implications I see around P11D, obtaining data from third parties, because the time frame is quite small. You've got from the end of the tax year until the 6th of July to get the forms completed, to get them agreed by the individuals. Most companies send them on to employees before sending on to HMRC. One of the challenges we still have from a technology perspective is your submission to HMRC can only be done once if you're doing it online. So if you make an error and need to update them, you then have to submit the second one by paper copy. So it's a bit of a ball ache. You can't submit it electronically like you can with payroll. Company cars remain particularly difficult. It always amazes me some of the third parties, some of the reports I get from clients, from the third parties for clients. Cars change fuel type, change dates, change list price from one year to the next. So I always recommend to clients to review their P11Ds this year against last year, to make sure that the benefits that were on last year are on this year, provided there's been continuity, and to make sure that, say, the car or the loan is the same as it was last year. Just other points, reimbursing private fuel. If you do provide private fuel to employees in cars, you have until the 6th of July for the employee to reimburse it, and then you don't have to report it as a benefit. If it doesn't get reimbursed, then obviously you need to report them as a private fuel scale charge. There are penalties for late forms. There are penalties for incorrect forms. I generally don't see the penalties for the incorrect forms unless it's part of a bigger review. They're used as a threat usually, but the penalties for late forms are automatic. PAYE settlement. Yes.
Before you get on to PAYE settlement agreements, very quick question. I'm going to put you on the spot, which I know is always dangerous. You may not know the answer off the top of your head, but when an employer funds the cost of outplacement support for a departing employee, do you know off the top of your head whether that is something that should appear on the P11D or whether there's an extra statutory concession that means you don't have to? My understanding was there was something to do with if it's automatically applied to everyone, then you don't have, there's an extra statutory concession. But if you just pick and choose who gets that support, then it's taxable and has to appear on the P11D.
You're right. Putting me on the spot is difficult, especially with one like that. There is an exemption. There are a number of exemptions in different areas, etc. And I don't know, I cannot remember the exact wording of the exemption off the top of my head, but yes, some of the outplacing stuff does not need to be reported, but you would need to meet the requirements of that exemption. And it is something like it needs to be available. It might be available to all. It might be in specific circumstances. They depend on what it's for. But as long as you meet those exemptions, then yes, you wouldn't need to report it.
That's really helpful. And it's obviously
uh,
very topical at the moment with all the redundancies going through the system.
Yeah, and another interesting one actually is, and back to cars, is pool cars. So a lot of companies have the use of a car. Now with pool cars, again, there's exemptions about whether it's a pool car or not. And there's 5 different points. If you don't meet every one of those 5 points, it's not a pool car, it's a company car and needs reporting. So yeah, it's just another of those types of benefits that has exemptions. Just need to make sure that you meet the requirements of that exemption. And if so, then great, it's not taxable, you don't need to report it. So then moving on to POE settlement agreements, and I am almost there, so I'm almost keeping to 35 minutes. The POE settlement agreement, essentially anything you as a corporate provide to your employee that is a benefit needs paying tax, needs reporting somehow. So either payroll, P11D, or PSA. So PSA is the way to, it's the collector. So if you've provided your employees with staff benefits, with staff entertaining, then strictly you should be picking that up as part of a PSA. PSA needs to be agreed usually by the start of the tax year. It's cleanest to do it, and then it will stay. You'll stay forevermore, but you then should review it to make sure that the items within it are still accurate. It covers all minor, irregular, or impractical expenses, which is why things like staff entertaining is the best example of that. Essentially, you include it on the PSA, you then gross up for tax purposes, and you would pay what's called a Class 1B, same as Class 1A, etc. Calculation. That calculation has to be done and paid by the 19th or 22nd of October. So obviously the way the process works is payroll, everything gets done end of the tax year. Anything which is taxable benefit gets done by the 6th of July. Anything that's not been picked up there, you need to put into the PSA. And I do find a lot of companies don't have a PSA, and then you go and review their arrangements, and they have lots and lots of staff entertaining, lots of staff benefits. There are exemptions and things that don't need to be reported. So you have things like annual or Christmas parties, then great. So some staff entertaining won't need reporting. But again, there's requirements for how, and there's limits on how much you would be allowed to do. There's a trivial benefits exemption. So as long as you meet that, you can provide gifts to your employees as long as you meet the requirements of the trivial benefits exemption. One of the practical points within this is if you've got overseas staff coming over and you entertain those, you should be including the cost of the overseas staff. So it includes all costs associated with it. So if you put people up in a hotel and it's purely just for the staff entertaining, you should be including those hotel costs as well. Not if they're for business, but if they're for the staff entertaining. And one of the challenges does come about whether you've got client entertaining and staff entertaining, and when you've got a mix. And again, I could bore you for hours around what's classified as allowed and not allowed, but it's just something you have to look at and then take a judgment call on whether it's client or whether it's staff entertaining. Final slide is then just other topical issues. And I'll just cover one of these in like 2 minutes. Termination payments I've mentioned. We've got the PEMP calculation now. The big thing I find with that now is we have to do that calculation. With any termination payment nowadays, you have to break it down into the component parts of the settlement. So what bit is to do with holiday pay, what bit's to do with notice or contractual payments or bonus, what bit's actually to do with ex gratia, and then each of those will have then a calculation associated with it, and it needs to be treated correctly from a tax perspective. And obviously now one of the changes is that whole £30,000 exemption used to be NIC-free but taxable. It's now so anything over 30,000 was subject to tax but no NIC. Now there is actually national insurance on the over 30,000 as well. I mentioned there different working practices. Obviously we've all come out of COVID and a lot of us are now working in different ways, whether it's at home, whether it's mobile, whether it's overseas. A lot of the questions I get now are, I've got this person working in Germany or Portugal. Some countries are actually creating a advantageous tax rules in that jurisdiction so a lot of employees might be going over there going, actually I'm going to work over there. Need to think about how that works from your perspective as a UK employer and whether you have rules, obligations that you need to meet. And a good example is someone that goes to say Portugal. works there, and if they're concluding contracts over there, you as a corporate could end up having a potentially permanent establishment over in that country. So there are obligations and issues by having mobile workers. From a UK perspective, we got lots of relief in the UK around we're having to work from home. Some of those rules are now stopping. So there's a lot harsher rules around what you're allowed to claim tax relief on if you work from home through choice. So if you have an option to go into the office, you can't necessarily get tax relief for certain things anymore. You could during COVID times, you can't anymore. In addition to that, where you've got people who are mobile working, there's this concept of temporary workplace and permanent workplace. If someone stays somewhere because of their choice, it doesn't necessarily mean it's a temporary workplace. So again, it's just something that you as a corporate and as an employer need to be mindful of. And that's before you get into the whole HR issues, training, employee engagement, etc. So again, another subject which I could probably talk for hours on. I'll leave the final topical issue that I'm really seeing a lot of lately is fuel reimbursement. So at the minute, and this isn't just about company cars, it's about, say, where you've got people that are in their own car doing mileage. We've got the concept of petrol vehicles, diesel vehicles, plug-in hybrids and EVs, all of which have different rules behind them. EVs run on electric. HMRC do not see as electricity as a type of fuel. So we have a difficult combination of rules being applied to reimbursement of business mileage. It's a bit of a minefield. It's a bit of a nightmare. We keep lobbying the government to hopefully clarify the rules. And some of the HMRC guidance isn't quite accurate when you read it online. So if people do need advice, I'd say please seek your tax advisor or phone up me, and we can always have a brief conversation around what that looks like and how that where the complexities lie. The final bullet point, immigration issues, was hopefully a segue back into Simon to plug next week's session, which is going to be on immigration, Simon, as I understand.
It is indeed, but we're going to hold that thought, David, because we've had 2 questions come up on the chat, which I want to put to you, if that's okay.
Sure.
First one is just referring back to PSAs, PAYE settlement agreements. And I think you commented they have to be set up at the start of the tax year. So the question is, what do we do if the tax year is underway and no PSA has been put in place and we think, we should have done one? Is there anything you can do?
Yep, you can still do one, still apply to HMRC 4.1. The problem is then the calculation, there's, without getting into too complexities, the national insurance point then has a slight wrinkle in it because you haven't agreed the items with HMRC before you've provided the items. So effectively, it becomes a slightly more expensive one because you have to apply NIC to a lot of the benefit rather than just applying Class 1B. So you can still you should be able to still get it if you haven't got it already. But I would do it as soon as possible. And then usually HMRC will backdate it to the beginning of the tax year, but they may insist on a strict calculation, which is slightly more expensive than if you set it up at the start of the tax year.
Yeah, that's helpful. Final call for questions. I'll ask this next one, but this is an opportunity for any other questions just to be put through that chat. So this next question, it's on a related theme, and this is the question of trivial benefits for staff entertainment. So take the team out for lunch, but cost per individual is less than 50 quid or something.
Yep.
Can you use that exemption?
Yes, that should be fine. That where you need to be careful is because once you do it twice, then it's probably more than 50 quid.
Makes sense.
It's so it's one of those things. If it's a one-off, then yes, it's probably okay. And if it's happened twice and it's £52, I'm not going to sit here and say you should report. You should go out above and beyond and set up a PSA for a very, very small amount. And when you look in the revenue guidance, they don't want you to do that. There is a concept of tax administration not overriding the cost of tax, if that makes sense. So if your PSA costs come to a very small amount, then really you shouldn't even be doing it. Yeah. But we do need to be paying the right amount of tax.
Yeah. I've got a question as well. Lots of red flags that you've talked about here from a compliance perspective, and thinking about Donald Rumsfeld and his known unknowns. If I were attending this webinar, I might be thinking, crikey, there's some stuff here that we might need to get under the bonnet and have a look at what's been going on. I mean, is that something you advocate? Do clients ask you to do audits and that kind of thing? Is it wise to do that, or is it better just to leave it untouched and don't poke the bear?
Okay, so given I sit on the subcommittee for chartered tax for CIOT and I'm a chartered tax advisor, I cannot advocate doing nothing. Okay, but there are plenty of companies out there who take a risk-based approach to taxation, not just employment tax, any tax. So they might choose to do nothing because they're happy with their processes in place. But putting your best endeavours and best foot forward, and as part of the SAO agreement, and I know that's for big corporates, but it applies to corporates across the board, you should, and when HMRC come in, you should know what your policies and procedures are for paying the right amount of tax. Now, how often you review those and how much, what the level and extent of review is down to you. Yes, I help clients review. And you go in, you do an aspect review, you do a limited review and say, look, yeah, these bits are great. This bit might not be. This bit, actually, that's a red flag. You should probably look at it. Then it's down to the clients to decide what to do. So if I went in and found someone's got an issue with 3 contractors out of 20 or 100 contractors, they might choose to put it right and then do nothing else. If they've got an issue with 47 contractors out of 50, they have to make a voluntary disclosure to HMRC, because at some point they will get found out, and the later you run it, you have the issue incorrectly, the more likely HMRC to come down as being careless / fraudulent. Because if you found out about it, you need to put it right. But I would always recommend companies are on top of what their own tax policy is and how they review and stay on top of their own tax affairs. And yes, absolutely, I and other providers can help them do that, because it is a bit of a minefield nowadays. But companies do need to make sure they're paying the right amount of tax at the right time in the right manner.
Wise words, David, as ever. Thank you very much. Well, I think there's no more questions popped up, so that probably brings this session to a close. So thank you, David, for that. And I can see your slide is up there for anyone that wants to contact you sort of independently of this webinar to follow up. So by all means, do please contact David. I'll finish by thanking people for joining and for the questions that have been asked. Just to remind you that this webinar is part of a trilogy. The first one we had last week, Angus Menzies presented on the anti-strike legislation. You can go to our website and listen to the recording of that webinar if you've not heard it. Next week, same time, same place, we've got our immigration webinar that David trailed with the title, Do You Need a New SUV? Nothing to do with cars this time, but scale up visas and a look at global business mobility. So definitely topical and of interest to many of our clients, I'm sure. So do please join us for that. Look out for the invitation coming. Share that with your colleagues as you see fit. The recording of this one will be available as well. And if anyone wants the slides, just drop me or David a message and we'll be able to share those slides with you as well. So I'll bring this to a close now. Thank you everyone for your attendance and look forward to seeing you at the next one.
Thank you.